If you know where to look, there's some incredibly cheap stocks on the market and some that are buying back stock at an incredible rate. One of those stocks is MGM Resorts. Over the past year, the company's revenue is up 15% and its share count is down 12%. I'm going to get to the numbers and why I think this is a phenomenal value, why there's still growth in Macau. Las Vegas is doing extremely well, and that's not even counting the potentially massive impact that Japan will have on this company when that casino opens in 2030. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content, and thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. Let's look at some broad trends before diving into the deep numbers first. This is a chart that shows MGM Resorts revenue on a trailing 12-month basis, and then their weighted average shares outstanding over that same period of time. This is where you can see the revenue continues to tick higher coming out of the pandemic. That was initially driven by Las Vegas, now is being more and more driven by Macau. And management hasn't had a lot of new casinos to invest in. So with the stock trading at a relative value, which I'll get to in a second, they've said, hey, why don't we just buy back stock at the current price? So those are phenomenal trends, and I think they will continue. One of the reasons is because of growth in Macau. This is the gaming data directly from the Gaming and Inspection Coordination Bureau in Macau. You can see this is on the left is the monthly gaming revenue numbers. You can see that they've been pretty steady over the course of the year, dipping a little bit in June and July, but now ticking back up in August. So pretty consistent numbers. And if we look at the accumulated gross revenue numbers on a year-over-year basis, revenue is up 33% through the month of August in 2024. Now, the growth rate is slowing down because growth was picking up in 2023 at the same time. But even in the most recent month, growth was 14.8%. So that is pretty solid growth for a market that is still pretty mature. There's a lot of tailwinds. As economic growth in Asia takes place, Macau is going to continue to grow. Obviously, travel was restricted in China for quite a while during the pandemic. That's where you see a lot of this growth happening, is that those restrictions were taken off, and it seems like there's still steady momentum taking place right now. So that's Macau. Macau I would look at as just a cash machine for MGM Resorts. The company owns a little over half of that business, and that business just spits off a dividend year after year. Las Vegas, things are a little bit more interesting. Las Vegas had a huge surge in revenue after the pandemic. People wanted to go out again. They had extra money in their pockets. Room nights went up. The big thing was that casinos were making more money than ever. That momentum has slowed, and if depending on the month that you're looking at, maybe down a lot. Revenue in the month of July 2024 was down 15%. So that sounds alarming. But if you pull back, for the 3 months ended at the end of July, revenue was down just 3%. So you have those month-to-month outliers. And the 12-month number, revenue is actually up in the past 12 months to $8.9 billion. Now, there's going to be more volatility coming later this year as you have things like the Formula One race, really, really big numbers in Las Vegas. Sounds like that's going to be pulling back a little bit. People are just spending a little bit less to go to that Las Vegas race in the second year that it's being run than they did in the first year. But the trend here is that we should see steady continued growth in operations in both Macau and Las Vegas. And I think that's where you need to look at MGM Resorts valuation, because this is where it gets really appealing. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. With any gaming company, I think the best way to look at it is what are you paying for the enterprise value. So that's the equity value of the stock plus the debt that's on the balance sheet minus the cash that's on the balance sheet. That's going to be the enterprise value of the company. And then what are the cash flows that are coming from the resorts? The best proxy for that is going to be EBITDA, or EBITDAR as they're calling it now, which also pulls out rent. So we have to add back in that rent number. But if you add all of these things together, I think MGM is looking pretty compelling. So let's look at those numbers. MGM's market cap today, $11.11 billion. So that's what the equity value of the company is. If we look here on the balance sheet, this is June 30th, 2024. We're going to add in $6.3 billion worth of debt. There are other operating leases. These are the long-term leases to rent their properties when they sold them off to REITs a few years ago. I'm going to ignore that for now because I'm going to pull out that rent number in just a minute. So that is most of the debt. There's this very, very small amount of interest accrued on long-term debt, construction payables, but those aren't meaningful. So the other thing we're going to do is we're going to pull out the $2.4 billion worth of cash. So in total, you get an enterprise value of $15 billion. So next thing we need to calculate is EBITDA, or the proxy for cash flow. What I'm going to do is I'm going to take this $2.43 billion number. I'm going to subtract 300 million because remember they only own a little bit over 50% of the MGM China property. And I'm going to take that times 2 because this is the 6 months. So I'm going to just annualize these numbers. That gets you to $4.26 billion in adjusted EBITDA. And now we can go to the triple net operating lease and ground expense, $1.128 billion. That's on a 6-month basis. So I'm going to double that. So at the end of the day, you get $2 billion in adjusted EBITDA coming from MGM Resorts properties. Now, these are high level numbers, but if you just take that $15 billion enterprise value number divided by the $2 billion adjusted EBITDA number, and remember that includes that rent that's taken out, that gets you to an enterprise value to EBITDA of 7.5. That is a really attractive multiple for a company like this that has a wide moat around it. Not a lot of companies are going to be able to add new casinos. Land is sparse in the US, in Las Vegas in particular. There are no new licenses in Macau. And think about what we have not included in this valuation at all. I have not even talked about iGaming at all. That should be profitable likely later this year or into 2025, but that could be a boost for the business in the future. And remember, I talked about that Japan casino. That is coming in 2030. It is very possible that that casino will be the most profitable casino in the world. Wouldn't be surprised if that one casino generates over $1 billion per year in EBITDA or cash flow. MGM Resorts is going to own 40% of that. So what are they doing with this cash in the meantime? Like I said, there's not a lot of places where you're going to be able to build new casinos outside of this Japan one that they're building. But management is just buying back shares at this relatively attractive valuation. And depending on how you want to value other assets, if you want to use the equity value of the MGM China assets, if you want to put a valuation on the online betting business, the valuation could be even cheaper than what I outlined here. So they just continue buying back stock and continue reinvesting in the business. And that alone could be enough to help boost earnings per share by in excess of 15% over the next decade. So I think this is just one of the cheapest stocks on the market today. Like I said, wide moat around the business. This is now a cash flow business, and they're returning that money to shareholders at a really rapid rate. So if you haven't looked at MGM Resorts in a while, I think it's one to check out. Stock is about flat over the past year, and that's despite all of these operational improvements. But let me know what you think in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.